I'm sure you've seen how a stock that just reported earnings can explode upwards or crash downwards in just minutes. Perhaps that's left you feeling like you wish you could predict which way it's going to move so you could get in before the move. But what if you didn't have to predict it? What if you could take advantage of a big up or down move? And what if you could do this with a simple trading strategy that even a beginner can quickly execute? Well, in this video, we show you exactly how to do that. And we'll show you a specific example of how utilizing this trading strategy in a recent Netflix trade made a 40% return overnight. So stick around.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's Options Trading Desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. All right, and so we're right in the middle of earnings season, which is a huge opportunity for prop trading firms because of the massive amount of movement that can happen to the prices of individual equities during earnings season as Wall Street digests all the fresh news about the company and recalculates the value of the company based on that. And the fact that the market has been volatile all year only goes to exaggerate the sizes of the moves, all of which give rise to lots of opportunity for day and swing traders. And what's interesting is that earnings season doesn't just create opportunities for day and swing traders, it creates huge opportunities for options traders as well. And in this video, we're going to teach you a simple strategy that can be employed with certain equities which are about to announce their earnings without having to predict whether the market will react favorably or unfavorably to the earnings announcement. Now, before we get into the details of this specific strategy that professional traders like to use right before an earnings release, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use all the time, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open a free workshop registration page in a new window, so don't worry, you won't lose this video, or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. All right, now, the strategy that I'm going to be teaching today involves stock options for Netflix. And I realize that most of you know something about how stock options work, but just for a quick review, and this is going to be fast, what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of his stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock is going way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price, paying way below market. Or conversely, on the put option, even if the market goes way below the strike price of the put, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put. Now, on the other hand, at expiration, if you sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it again expires worthless and the call seller just pockets the premium. Okay, so with that said, Let's head back to July 19th of this year, which is the day before Netflix was going to announce its second quarter earnings. As you can see, it's been a rough year for Netflix with growing doubts about its subscriber growth and tons of streaming competition. And as a result, Netflix price has been cut in more than half and has been trading at or below 200 since May. And so immediately before an earnings announcement, what happens in the options market is that the prices of all the options near the price of where the stock is trading get pumped up much higher than normal because the options market makers know the earnings are coming up and that stocks usually move very substantially after their earnings release. And so if you're selling options and there's almost inevitably going to be a big move either up or down after an earnings release, then whether you're selling puts or calls, you're taking a much bigger risk than normal because if the stock goes up too far or down too far, the call sellers or the put sellers, as the case may be, are taking on a lot of risk, as we discussed earlier. And so as a result, they will build a very large price into those options to compensate them for that large risk. And that tendencies of options to get very pumped up right before earnings is what options traders would call a large increase in the implied volatility of the options derived from that stock. And so let's say that on that day, at the end of the day, the trader went ahead and pulled up the July 22nd options chain of Netflix, which is the very next options chain to expire. And the first thing he does is to take a look at the price of the 200 call option and the 200 put option. And so the way that option traders think, they take the sum of the call option price and the put option price right before earnings to be a kind of a rough estimate of how much the market thinks the stock is likely to move in either direction, up or down, after earnings are announced. And the price of those two combined, the sum of those two, is known as the at-the-money straddle price in the options world. And so as you can see in this case, both options are around $15 to $16 in value. And so the value of the at-the-money straddle is a little bit over $30. So that means very roughly that the options market is pricing in a 30-point move in either direction the next day for Netflix stock. So if a trader at that point went ahead and sold 5 of the 230 calls and 5 of the 170 puts, and then simultaneously bought 5 of the 250 calls and 5 of the 150 puts for protection, if he were to do that, then he would be executing what options traders refer to as an iron condor, expiring in 4 days, intentionally executed when the options are really pumped up out of fear of the move that will take place after the Netflix announces its earnings. Okay, so let's first break down the cash flow, what just happened. So you're going to be able to understand how this trade is going to resolve itself. And so we start with those 5 calls we bought at the money, and those sold for $5.70. And each options contract represents 100 shares of a stock. And so you multiply that by 100, and we sold 5 of them. And so when you multiply it all out, it comes to a cash inflow of $2,875 for selling those 5 calls. And with that same logic, the puts brought in $26.25, while our protective calls and puts further out at $250 and $150 respectively cost us $1,260 and $1,115, as you can see, which when you net it all down comes to actually a positive cash flow of $3,125. And your broker, by the way, is going to require you to have at least $68.75 to implement this trade, which is also the trade's worst case scenario. Let's move to the end of the next day. And as you can see, Netflix rallied about 15 points off its earning report, which is quite a bit less than the options market was predicting. And so let's see the implications of this on our trade at the close the next day. And as you can see, every one of the options that form our iron condor lost a great deal of value, with both put positions and the long call position trading for under 10 cents. And even the 230 call has lost most of its value, trading at 73 cents, when the day before it was trading at over $5, even though the market had moved 15 points closer to that option. And the reason that all of these options have lost value is that the market reaction to Netflix earnings is no longer a mystery. We know the market liked the report, and we know that it rallied 15 points. And so the news is out. And now we can expect more normal market movement because there's no other big announcement on Netflix coming out before these options expire, which is only in a few days. And so there's no reason to give the options a lot of value, as there probably won't be huge price movement at this point over those next few days. And so that tendency of the options market to recognize that the big market moving news is out and done with. And so we better reflect that in the prices of options. That tendency is what options traders refer to as the vol crush, which is short for implied volatility crush, and will be seen in virtually every options chain after an earnings announcement. Okay, so that's all well and good, but what effect did the vol crush have on our trade? Well, let's take a look at that in detail, because if we wanted to close the trade at this point, we'd have to buy back the short calls and puts and sell off the long calls and puts at the closing prices that we just saw, because that's how you close an option spread. And so let's calculate the result. And as you can see, we'll start out with the original cash flow from entering the iron condor, the 3,125 that we received initially. And then we've got to account for the cost of closing both the 230 calls and the 170 puts, buying those back, which, as you can see, were minimal because the prices have shrunk so much. And similarly, we got back next to nothing for selling the long positions at both to 250 on the call side and 150 on the put side. So essentially, as is obvious, the profit on the trade is essentially just a little bit less than the original credit we received for entering into the iron condor the day before, which is considered a highly successful earnings iron condor trade in this case, yielding over 40% return on the capital deployed in the trade in one day. And so what I'd like you to take away from today's video is that there are a lot of strategies that options income traders can employ to take advantage of the initial expansion of options pricing and the subsequent shrinking of them, which, as we just explained, is referred to by options traders as the earnings-related vol crush. And you saw a vivid example of just how much those options prices get crushed after earnings, allowing us to close the position, buying back the short options for pennies on the dollar, collecting a small amount by selling the long options, and therefore being able to retain almost all of that original credit, which can bring in some whopping returns, as happened in this case. Now, not every earnings play is going to turn out this way. Obviously, if the options market underestimates a move resulting from earnings, there can be a loss on this same kind of trade. And so to defend against that possibility, professional traders like to look back at the last, say, 5 to 10 quarterly earnings reports for a given ticker symbol to determine if the options market under or overestimated the moves in general. And they'll often place their bets on stocks where the market consistently overestimated the move, as it did in this Netflix case. Regardless, the potential for significant profits overnight are there, and professional traders are well aware that earnings season brings these kinds of opportunities in droves to people with knowledge of options. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll be learning 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.
So now you know how to take advantage of a stock that's reporting earnings. But earnings happen only once a quarter for each stock. So while this is an awesome strategy, you're going to want more. You're going to want a more consistent income, which is why you're going to want to watch this video that's appearing on your screen, in which we teach you how to effectively generate consistent monthly income with another simple strategy that even beginners can learn quite quickly. So make sure to check it out by clicking the video on your screen right now.